Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Marcin Drozdz. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Marcin Drozdz. He is a managing partner at M1 Real Capital, and they're focused on acquiring value-add properties throughout the Southeast U.S. In just a minute, we're going to speak with Marcin about attracting capital for multifamily syndication. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel, and you can find us on YouTube at Commercial Real Estate Pro Network. With that, I want to welcome my guest, Marcin. Welcome to CRE PN Radio.
Thank you, sir. Really happy to be here. Excited.
Well, I'm looking forward to our conversation today. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. The 30,000 foot view was, I picked up the book Rich Dad Poor Dad while I was in high school. Like so many other people, read it, blew my mind, thought to myself, I could do this. And, one thing led to another, bought my first rental property in my, it was 20 or 21 years old, learned about negative cash flow right away and all the fun, creative techniques to kind of make the most of it. Sold that property. I did quite well. Several properties later, got recruited into private equity, moved out west, ended up working on the real estate side in the equity area there. And it was tremendous because you went from buying single family homes or small multifamily on a personal level to, here's this 200 unit, 55 plus community. Here's this, 300 unit purpose built rental property. Here's this XYZ, fill in the blanks. And you're just like your mind's just blown. Like the quantum, the size of transactions was tremendous to see it in your early 20s. For me, I thought I died and went to heaven. It was amazing. So I did that for a few years, had a lot of success on the equity side, learned a lot of, really good lessons, worked with a lot of really smart people. And after a few years, realized that, that business, as great as was, didn't lend itself to me building a business, but fitting within the context of somebody else's business, which is great. And that's a great outlet for many people. Didn't really work for me. So after a few years, I broke out, started putting together my own funds, focusing on opportunities. So if you recall, after 0809, the carnage that ensued in the commercial sector, we put together an 8-figure fund, went down to AZ and started buying up whatever we thought made a good idea back then. And you could buy 7-8 cap buildings, a third occupied, or pardon me, 2/3 occupied, and pay just for the remaining NOI. And we sold out a few years after that. And I thought when we sold, that was close to what was the top. And boy were we wrong. And then fast forward to today, still buying multifamily, southeast. Mostly value add, and having a lot of fun doing it. So,
and I appreciate you sharing that. It's funny, the 08 crash, and for as long as I've been doing this, people have been saying, "Yeah, we're about the end of the cycle." We're in the second or late innings. Maybe we're in a double header, whatever analogy you want to use. But I think one of the things that I find that I'd be kind of curious to get your intake on this. I mean, as a student of the market and kind of, as an investor and just kind of, I think one of the things that I keep looking for, and I think that it's kind of a memory situation that we have with it, just as humans, is that when we see something, we look for it again, or we look for the reoccurrence. And if we go back on charts and graphs, and we can always point to the point on the graph where this in the cycle it happens. But one of the things I think is really hard to account for is the corrections that are made in those cycles. And, were the corrections that were made uh, this last cycle, did they prevent a major crash, or is it more of just good times have been going on, or even financial policy that's continued to propel us in um, this way? But
Well,
so
it's interesting that you say that, Darren, because the crash in 08, 09, everybody knows this by now. That was a debt crisis. There was a tremendous amount of oversupply. There was a ton of credit out there. And, when the party ended, the banks, and in hindsight, they would have probably done it much differently today. When they stopped lending and they actually withdrew out of the market, it created a tremendous hardship on the economy. And it's easy to talk about it in hindsight today as an expert, because we've all seen the movies, we've all seen the documentaries. It's pretty self-explanatory where the thing broke last time around. I think the difference today is, even after all those restrictions were put on, and the CMBS market, and the debt, the collateralization, and the repackaging of securities, and all this stuff that created these the over just the market that we had. I think the major difference today that I certainly didn't account for was the sheer volume of government intervention with the stimulus over the last, take 2008 right up until today. I mean, the quantum, like the sheer volume of government intervention. I mean, I've seen statistics anywhere from, the last 12 months, they've added 40 to 80% of additional dollars to the money supply, right? And I think the thing today that's so different, and it's very difficult to quantify with traditional risk metrics, and how we were trained to view risk, and how we were to, like, even in your underwriting, when you're buying apartment buildings, we were always told use 1 or 2% for your rent growth, 1 or 2% for your expense growth. Today, those numbers are out the window, all of them, whether it's your rent growth, whether it's your expense growth. There's, your financing, like, all of these components today are flying in the face of how those in the space have been trained for the last 10, 20 years. And I honestly think that's a function of, we've never, in North America, we've never seen run up inflation. I mean, fair enough, there was inflation in the 70s and 80s, and that was addressed in a very different way than today, than it's being addressed at this point today. But there's other parts of the world where this story repeats itself over and over and over again. And I'll give you an example. I was born in Poland during communism, and we had something called remuneration in 1995, where they rolled back the dollar, the Polish dollar, from 10,000 to 1. So if you had 10,000 in the bank, they rolled it back to $1. And we've never had this. US, Canada, we've never experienced this. Other parts of the world, because US being the world reserve currency, and all commodities throughout the world being priced in US dollars, that dollar has never been scrutinized in that way. We've never had those types of issues here. And I remember my grandma, I would go to the grocery store. I went back to visit my grandpa when he was getting a little bit sick. And I remember my grandma gave me $1 million bill, and this was like 93. And I got my goggles from here, right? So I'm there, and I'm like, grandma's a baller. Like, she gave me $1 million, right? I go to the grocery store, and I buy, I don't know, a bag of chips, Coke or whatever, some gummy bears. I get 300 grand in change, $300,000. So I come home, I'm like, all right. And I don't know what's going on. I'm a kid. I just, I think it's all monopoly money anyway as a kid, right? So my point is that in 95, a few years after, when they remunerated the dollar, it was $10,000 to 1. They rolled it back. So the people that got wiped out were in cash equivalents. They were holders of debt. They were holding the debt on someone else's asset. And the people that maintained their purchasing power, or potentially disproportionately grew their wealth, were people that held real assets, whether it was real estate, whether they had the means of production to producing food, whether they had, a winery, farms, farmland, timber, whatever, mills, whatever it was. Those were the people that really maintained their wealth and their standard of living. And if anything, they've disproportionately benefited from that. So I think that's something that we really haven't seen here in North America just yet.
Well, I appreciate you sharing that perspective, and I didn't mean to get off on a tangent to start here, but
That was my tangent. Sorry
well,
about that.
no. I mean, I even just the bringing it up here, but just yeah, I think the key to this period we're in, and I think you nailed it, talking about the stimulus money that the government has put into the system, period, and whether it be from the economic or the lessons learned from the depression, and whatever, and trying to keep things afloat as opposed to having them crash hard and despair and blood in the streets and stuff. The only thing that I think that not the only thing, one of the many issues with that, and we'll move on here in a second, is that every time you tamper with the markets, if you say the markets are pure and that there's a point where buyers and sellers meet, and that's where supply and demand, and the price is set, and that's a pure market. When you kind of bastardize the market when you inject an unknown the government currency into it, to where all of a sudden the values, I mean, it's everybody's like, wait, and you have all this additional money pumped in, and these things that would happen naturally don't happen. So now you've got this kind of artificial baseline, and I hope that we don't end up in a situation like you shared with in Poland and stuff. But you're right, though. I mean, with other countries and their currencies and the devaluation of it and all that. I mean, it's not that it's not impossible to see something like that happen.
No, but and in fairness, Darren, I mean, you and I both know this. We typically, in human beings, I don't know what it is. It's probably within us, where we sometimes overestimate the proximity of short-term events and totally disregard longer-term trends, because they're over such a long period of time. And I say this because typically whether it's a fiat currency or inflation doesn't just go from 0 to 100 in a day or a year or 5 years, for that matter. This is a compounding annual. Even if you look at historically Argentina, Venezuela, other countries, and I'm not equating the US to those countries because apples and oranges, but even those types of countries, before they hit their strides, the wrong word, but before inflation really became pernicious, where you're in hundreds of percents per year, there were run-up years of 3, 7, 12, 23, 83, 90. Like it takes years, sometimes decades, for this thing to play out. And the one thing is there is no fiat currency throughout the history of the world that has ever survived, ever. And before the US was the world's reserve currency, the pound was the reserve currency. Before the pound, I think Denmark had the guild. I forget the name of it, but there have been various different reserve currencies throughout the world that empires were built around, and no one empire lasts forever, but also they don't come down overnight either, right? So
right. Well, and to all that, hopefully the landing is, we can all stick the landing and continue on. And although, having said all that, typically the opportunity lies in the down.
Well, and Darren, the counter to everything I just said, not to sound totally talking out of both sides of my mouth, but that's what it's going to sound like, is the counter to what I just said is the US is also the world's largest exporter of technology. So there's things that we don't even know that the US is going to manifest within the next 5 or 10 years that's going to fundamentally change how everything works, right? So,
right.
We may not have the coal mines and the steel and all the means of traditional production, but some of the biggest companies in the world as far as technology goes, that comes from here. And whether it's AI or all the different various forms of what the future is going to take, a lot of that is coming from the US. So you also have to look at that as the counterbalance, right? So what is the net result of it all? And I'm sure there's people 100 times smarter than me that can probably speak to that, but it is a trend. Like, this inflationary trend is a very real trend that we do have to contend with.
Yeah. Well, and as I understand, the Fed's continuing to try and slow it down and
Mhm.
and you know get it under control. So hopefully they're successful without too much pain, and there's plenty of opportunity to recapitalize and
Mhm.
do more. So, but anyway, let's talk a little bit about multifamily. I wanted to hear a little bit more on. You mentioned how you had your first property. You said you were in your early 20s when you bought a
Yeah,
single family.
I think I was 20 or 21 when I bought my first house, and I listened to the realtor. They told me I'd get 2,000 a month rent, and this was way back then. So I bought it. It turned out that I didn't. And you learn how to do your own due diligence very quickly when it starts to cost you money.
Well, what a powerful lesson so early on. In fact, even the fact that you said you read Rich Dad Poor Dad in high school, I mean, I think that's awesome. Just to get that kind of a frame, to frame the world and the opportunities as far as what you can do and taking control of it as opposed to just listening to the message of, get a good education, get a good job, go work for somebody else kind of thing. I think that's awesome.
Yeah.
So when you were working for the real estate equity firm, were you strictly working in multifamily, or did you work in other asset classes, or how?
We primarily did multifamily. We did do some other assets. We did some commercial. We did some land assembly as well. But I'd say 3 out of 4 deals that came out of our shop were multifamily. And by and large, it was US based. And just for context, it was a Canadian firm at the time. So even back then, we were doing mostly US multifamily. And here's something else that I'll share with you. A lot of people think that whether you're investing in Florida, Tennessee, or you're on the West Coast and you're buying whatever you're buying, I know prices have gone up a lot in the last, well, pick a date, 2 years, 5 years, 10 years. But I'm going to borrow this from Jason Hartman. He always has this comment: expensive compared to what? And when you use that analogy, you'll recognize that the US, even during this run up, is still some of the best priced real estate, uh, dollar for dollar, as the asset class is represented compared on the world on a world stage. So, for example, in Canada, multifamily trades at a 2 cap, sometimes even in the 1 caps. It's insane. You look at other parts of the world, Europe, Australia, other developed countries. And when you look at the US trading at 4 caps, 5 caps, and people are like, that's crazy, that's insane. Well, compared to what? and then when you combine that with the fact that in the US, and I'm pretty certain of this, I think the US is the only country in the world where you can get a fixed term and fixed rate mortgage for 30 years, whether that's residential or commercial. You can't do this in, well, Canada, for example. 5 or 10 years is the maximum term you can get with your rate. Am schedule, sure, you can get the extension, but the term, you can't lock your debt in for that long. And I'm almost certain that there's nowhere else in the world where you can get 30-year fixed term debt as well. So you combine the pricing, the income relative to the purchase price, your world with reducing risk, the replacement cost, the cost to replace the asset. Regardless of what's happening at a world stage, I still think the US multifamily market, obviously market by market, is a tremendous opportunity going forward, especially with the inflation potential.
Yeah, I love the perspective there, because I think that for me the challenge is not so much that I'm waiting for the crash, because I feel like it's a different set of circumstances. Like we've been talking about, there's all
Mhm.
this new capital in the market, and it's kind of invented money from the government that kind of inflates everything just by sheer introduction of the money into the marketplace. But I think just mentally, if before I got used to a certain price as being expensive, or then I adjusted to that's the market, there's a lag for my brain to go, well, this is the new price. It's not until you go spend some money and you realize that whatever you were used to spending is not enough, and now you've got to spend more, that now you realize there's that delta, and that becomes the new baseline, that all of a sudden it recalibrates. um, because and especially when it's sudden, or it feels sudden, within like a year, that the transitory number, or the number, translates from X to X plus. um, So I think you really have to, you have to be in the market and play in the market and run the numbers in the market on a regular basis. Otherwise your reference point will be back at whatever you acquired something at, or the last transaction you did. And if it was, a year, 2, 3, 4, 5 years ago, um, you won't have that, your reference point won't be current, you know. And so at least that's kind of that's where I guess I'm trying to reconcile in my own brain. It's just that that's really that's the exercise I have to do to just to try and for a reference point mentally, to make it I don't know, to
Make it make
reconcile it.
sense.
Yeah, yeah.
Well,
Yeah.
and Darren, I'm of the same mind. I mean, even most recently, I was dealing with my underwriting team on a property we just wrote on here in Florida. 90 it was 90 units. I'm hoping to buy it for 11 million. Whether whether my offer is considered or not is another story. But that equivalent property a few years ago wouldn't have been 11 million. And I can tell you that it took me a minute to get to 11 million. And, my underwriting, I mean, traditionally you would take, you know the business, you would take a 1 or 2% rent growth assumption after your value add. And that's responsible. That's standard. Today, 1 or 2% is not what we're seeing. So the question is, do you believe in risk? Pardon, not risk. Do you believe the risk? This is the risk. The risk is, do you believe that inflation is in fact transitory and we're going to come back to normal? Or are we going to be at an elevated level for the next few years? And I can tell you our insurance providers are underwriting for elevated levels because the new premiums, the new quotes we're seeing, Marcus Millichap put out a report on, they were one of the charts that they put out was the replacement costs, and construction costs have gone up almost 20% year over year. And they're expecting the same increase year over year on top of the last year over year this year. So, what is that going to do to premiums? What's that going to do to rents? What's it going to do to construction? I had somebody just send me a development project with some, 50 doors on the property and a few acres to build on to get up to 250. And I'm looking at this thing and I'm like, how do I price this thing? Like, how do I price construction? And because the market's moving so quickly, it is a different game. And on top of that, today compared to 08, 09, there is a deficit of over 4 million houses. There's 4.5 million. I forget what the number was, but there is an acute shortage of housing. And you combine all of that together, and regardless, interest rates are going up, and I don't have a crystal ball how hard they're going to go, but from what I'm seeing is if you're running inflation 7-8% as far as what it's posted, so okay, if rates go up to 4% or 5%, you're still below inflation, which means you're getting paid to take debt. I mean, when was the last time we had something like this?
No, exactly. And the, just I think the key thing to this whole, the market of multifamily housing period is just what you
Mhm.
cited. There's demand.
Mhm.
And so I don't care how you slice it, whether it be, inflation or the cost of replacement cost or just your operating cost or whatever, fill in those numbers that you're used to being more now than what they used to be.
Mhm.
The fundamental concept that I'm trying to remind myself of on a regular basis is there's still a shortage of housing, period. And that's not going to change overnight. It's going to take years. Now, if all of a sudden every obstacle in the way of development gets green lighted and the money just gets pouring into that, you could have a rush to development that could overdevelop, and then you could have a crash on that direction. But just based on the numbers, it's really hard to see that would be the case in the short term.
Well, and I mean, on top of that, we can talk about the labor shortage, the fact that people aren't going back to work for whatever reason, valid or invalid. And on top of all that, you can talk about the fact that I mean, okay, so on the heels of the 08, 09 crash, builders literally stopped building all
Right.
throughout the US. And that deficit grew and grew and grew. And I think if I look back at the chart, it wasn't until 13 or 14 that they even started getting close to fulfilling, to bringing new units onto market as properties were beyond their useful life. So you have this huge hole and you have this massive demand. You've got I forget how many millions of additional households you have since the last time construction was on pace to meet supply, and all of these things. And now in an environment where A, people aren't going back to work, B, you have lumber through the roof, steel through the roof. I had a gate that we put out one of our properties 2 years ago. That same gate got quoted for 2.5 times the amount. Literally a year and a half later. I'm like, really? Yeah,
And I
look at
think on construction right now, if you get a quote and they'll honor it, you need to lock it in. I mean, just lock it in
well,
and get it
everything
done.
is cost plus now. Nobody's
Right.
doing, I'm not seeing fixed rates.
Yeah. No, it's very hard for everybody to price. Yeah, I mean, you can run the numbers, and you mentioned insurance. I mean, we try and do a replacement cost estimate, but it's still just kind of a shot in the dark. You're hoping that that's a number that holds up. But anyway, hey, let's talk a little bit about raising capital. You've clearly you're an experienced investor. You've worked for others. You have your own fund now, and you're um, doing deals in that. What as long as you've been doing this, what are some things that you see as key for somebody that's looking to raise money to be successful raising money for multifamily investment?
It's a really good question, because you can have the best deal in the world, but if you don't know how to get the equity together, then you're you don't really have much in front of you. So and I'll obviously preface all this with, when you're raising money, it's a regulated business. So get the legal, get the accounting advice. Don't cheap out on this stuff. Get the right lawyers, get the right accountants, because capital raising is a business. It's its own business, and US, Canada, it's a regulated space. So let's make sure we address that first. As far as actually practical tips for somebody to approach fundraising, I created something called the EASY system, which is, it's an acronym. EASY is E, exclusive, A, abundant, S, scarce, Y, your allocation. So what the system does is it creates a reminder for people to look at their fundraising activity, number one, from an exclusive standpoint. So in other words, what makes your deal exclusive in the context of something that the everyday person can understand? Don't immediately say to me, well, the going in cap rate is 3 and the exit cap rate, we're going to bump it to a 5 and then we're going to bring it down and scoop up a couple $1,000,000. That's great. I understand you. 3% of the population will also understand you. What about the other 97 that could write a check? So exclusive. Speak to me in the context of, okay, rents are 1,000. They should be 1,200. Great. There's $200 a month in the rent. There's 53 units that we can raise the rent on. Okay, great. I understand that. That makes sense to me. If I'm an entrepreneur that sells widgets and I've got money to invest, you're speaking my language. I get you. Something else. Okay, it's on the corner of Main and Main. There's 50,000 cars that drive by every day. There's no vacancy in the area. Great. These things make sense. What else? This thing was built for $10 million 20 years ago. Today it would cost you $35 million to build. Okay, I get that. I understand the tangibility of that thing, especially now when I see cereal going up, $1 every 3 months that I go back and I'm buying the Cocoa Puffs for my child. I see the box went from $4 to $5. I understand. Like, speak to me in a way that I can relate to it. So again, establish the exclusivity of what makes your deal unique. That's really important. And that applies for whether you're marketing your deal, talking about your deal, trying to get lenders, partners, property managers, whoever it is. They need to understand what you see in a brass tacks way. That's number one. Number two, A, for abundance, make sure you have a lot of people to talk to. Obviously, sounds obvious. Most people don't go out until they have a deal and then they think the deal is going to quote unquote sell itself. If deals sold themselves, you wouldn't be here. and the deal would be done. There'd be nothing to talk about. There'd be no opportunities out there for you. It would already be done. It would have already happened. The truth is, you need a network of people that want to engage with you in the conversation, whatever it is, whether it's real estate, finance, and you got to find a way for people to want to engage. And it's not about selling your deal. It's about positioning yourself as a thought leader and having a large network of people to talk to. Now, again, what does large mean? Well, it depends. Are you raising 100 grand or are you raising $10 million? The size of your network will determine your capacity. I mean, in my first year, if I got a check for 50 grand, I was tickled pink. Today, that is a rounding error, and it's all context based, right? So where are you in that? But make sure you have a lot of people to talk to in your world that are constantly looking at you as someone who's credible. S for scarcity, there's two types of scarcity. One is the amount of equity that you require. It's finite. You need $1 million, you need $10 million. What do you need? There's a finite amount. Two is the time. So when is the transaction closing? Those two things will give you the ability to create urgency without being pushy, because you're factually stating where you're at. And it could be as simple as, actually, I'll get to this in a sec. And then the why is I call it the your allocation, but it could be your action item. So what's your next step? What is the compelling reason for somebody to engage in that next step of the conversation? So for example, Darren, if you and I were talking, I might tell you, hey, there's this building, there's 200 units. It's on the corner of Main and Main. There's about $300 in the rent. Look, the vacancy here is 2%. Someone moves in, someone moves out. There's literally no available real estate. Abundance, as you probably know, I've got a bunch of people that I've got to get back to. We've got our group. Last deal sold out in 13 days or whatever it is. Whatever your story is with where you're at, it's important that you accentuate that. And it's not showing off, it's just factual. Here's the deal. I have to present it to this many people. I'm only looking for $2 million. We're closing on X date, whatever date, 45 days from now, 30 days from now. And look, I know you got to do your due diligence, and I'll send you the package. But if this opportunity did check out for you, what kind of allocation would you potentially consider? And it's just a very soft, professional way to get to brass tacks. That's what it is. Now, everything I just said can layer into dozens of other conversations, and that's one of the things we do at M1 is with our students and our clients, we help them position their equity raises in addition to buying our own buildings. But if nothing else, that EASY will give your listeners some structure to be able to pursue the conversation in a more meaningful way.
No, I love the way you set that up, just in one, speaking in a language that's understandable. But in softly getting some commitments along the way. And one of I think it was the abundance about having this conversation with a lot of people. If you need $1 million and you only talk to one because you think they've got it, chances are you won't get it. But if you speak to 100 and you're trying to raise 100,000 per or whatever, there's a good chance you can over subscribe and when it comes down to it, especially if it's a good deal. If it's attractive and you've communicated that. I had a coffee this morning with an investor, he was a syndicator, and we were talking about just that. If you don't have enough in the pipe and you get down to it, and all of a sudden two pull out, or somebody starts, kind of wobbling or whatever, you can all of a sudden end up in a more precarious situation than you thought. Just based on not having that abundance of subscription and people lined up there. So that's a great some great keys there.
So when I left the firm and I started doing my own thing, we were putting deals together, and I one month I had 3 closings on 3 smaller properties that I was contemplating, and I developed the easy system out of necessity because I had the investor call me days before closing and back out of the transactions. So I was committed. Everything was set. Keys had been provided, instructions provided, everything was there. And wouldn't you know it, I'm I'm short, and I'm really short. So I sweat my way through that, figured it out, resolved it, everything was fine. But I swore to myself that I would never be caught in a situation like that again. And out of pure necessity, I created that system for myself because I didn't sleep for a few days, and I never wanted to have that again.
Let me ask you something, because this came up in this conversation this morning, almost in as much as that the the investor that had committed the funds, it was almost like a game to them. Like there was, if there were a bigger fish, they had kind of more control, and they had some sort of sense of that they could, and maybe were trying to get a better return than what the original thing was. And I thought, wow, that's kind of interesting. I'm not always the guy that's thinking that far in advance. I think that if you and I agree to something that, we've got that agreement, I'm not thinking, that you're going to come back to me and try and work me around kind of thing.
Yeah.
Do you find, some of the larger, more established capital, sources, is there any kind of a, um, I don't know, if it's ethical, or have you ever found that some of the larger, more experienced players might be more game oriented, or?
I mean, the old saying, he who has the gold makes the rules, right? So certainly some of the largest holders of the gold are the largest private equity firms in the world, and they know their position at the table, and the people that end up working with them, either for asset management or the equity piece, you give up the freedom of running things the way you want to run them because you accept cash from one group. You effectively become, and fair enough, if they're putting up all the money, they're going to want certain controls and processes in place that may run counter to how you're accustomed to doing things. And that's one of the perils of having one. I think that's kind of your point, is that if you have one investor that is supplying all, the cash, then that is, that's who you report to. Whereas if you develop the skill set where you can diversify your capital pool and not be beholden to any one group, you're better off as an entrepreneur, because ultimately you're able to retain your autonomy. I mean, you're still providing the reports, and you're still running a good business, and you're still doing things the way you're supposed to. But ultimately, if your largest investor is a couple percent of the equity, and there's dozens of these types of people, then you're in a much more favorable position to be able to run the business as you see fit, as opposed to having one person with 50 or 80% of the equity invested. So yeah, it's the devil's in the details, but giving up the so most people don't want to admit this, but they don't want to raise them. They don't like the act of raising money. They don't want to do it. But at the same time, they don't want to be beholden to the person that writes them that one check. So my whole thing is, if you don't want to be beholden to any one provider, you got to suck it up and learn the skill set. And if you have smaller check size, and I say smaller, perhaps 6-figure check sizes instead of 7-figure check sizes, you have more of those partners. But ultimately, you do more work up front, but then you can focus on the business more, as opposed to dealing with that one particular partner. And yes, I've heard stories of 7-figure, 8-figure commitments, and then 3 days before closing, oh, by the way, yeah, it's not 70-30, it's now 90-10. So I have heard of that. It's typically not well received in the community. Those groups are typically here for a short time. They're here for a good time, not a long time. Word gets around the campfire pretty quick if there's groups doing things like that. And operators talk to operators, entrepreneurs talk to entrepreneurs. Anybody who's trying to build a long-term business from the PE side typically doesn't do that. The people I've come across are typically very genuine, sincere, but from time to time you hear about the villain, the wolf in sheep's clothing. Yes.
Yeah. Well, it was, I mean, I've heard of people committing to something, and then right when they get to it, there's something that came up, there's something legitimate came up and stuff. And And that was enough for me to say, okay, yeah, you do need to oversubscribe. You need to get some reserves or, people in second position ready if a position opens up, kind of thing. But again, I think I mean your easy system there to me is ideal. Is an easy way to remember kind of the key fundamentals to make sure you have more than enough, that you're communicating, um, and you're going to get to the finish line. So I appreciate you
Mhm,
sharing that.
mhm.
Hey, Marcin, if we could, I'd like to shift gears here for a second. Um, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And typically, we consider one of three different strategies. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if there's a way we could transfer the risk. And
Mhm.
that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can take a look at their own situation. It could be the market, interest rates, um, the inflation, the politics, however you want to take a look at the or frame the question and the answer. But again, with respects to your situation, um, answer the question: what is the biggest risk?
Mhm.
And just for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer um, with that. So if
Okay,
you're
well,
willing, I'd like to ask you, Marcin
yeah.
Drozdz, what is the biggest risk?
Well, I was going to say, if it's an insurance question, I'd say the replacement risk right now is the biggest thing that is certainly ringing in my head. But if we're speaking in general, contextually as the biggest risk, I think right now the biggest risk is not doing anything and sitting on the sidelines and pontificating on what's going to happen next. Because, regardless of where we think things are going to go, and regardless of political leanings, left, right, center, wherever you're at, wherever you're going, ultimately, if you stood still for the last 12 months, you experienced erosion of purchasing power like you've never seen. And we've always known that inflation was kind of never I don't know anybody that believed that inflation historically was 2% or 3% or whatever we were told it was historically. But let's assume that was accurate for the purposes of what we're talking about. Today, they're flat out telling you it's 6, 7, whatever, 8%. And that trend is only compounding. So for anybody who's sitting still and trying to figure out how to move forward, I think that is the absolute biggest risk right now.
Oh, that's great. Marcin, where can the listeners go if they would like to learn more or connect with you?
Sure. Well, so the best way is my website, marcindrozdz.com, marcindrozdz.com. And on my website, we've got free resources as well for the people that are in real estate and they like the whole easy system. Or actually, even if you're a business owner, entrepreneur, and you're for whatever reason you're trying to raise capital or scale your business, I've got a free download there for the easy system where it actually there's a few videos. It's about 15 minutes of content where you can actually walk through it in a more orderly way. So that's available there. We do boot camps, we do trainings. We also have our own apartment buildings that we buy. There's a ton of free resources on that website.
Awesome. Well, Marcin, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, no, really appreciate it. And I think, Darren, if I could say one thing, your listeners today, more than ever, I think they need to look or relook at how they've minimized their risk, or like you said, transfer their risk on the insurance side, because it is a very timely conversation to have. So that, the fact that I like how you frame that, where you either transfer the risk, remove the risk, or what was the third one?
Minimize.
Or minimize the risk.
Yeah.
Yeah. You know, I think today that is a very timely conversation on the insurance side. Certainly that's something we're seeing across the board too.
No, I appreciate that. For our listeners, If you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.